Hello everybody, the topic of this section is analyzing cost-reducing projects. One major category of capital budgeting projects is cost saving. In this section, we will discuss the cost saving for a project by an example mainly. Let's see the example. Suppose a firm is considering an investment proposal to automate its production process to save on labor costs. It can invest $2 million now in new equipment and thereby save $0.7 million per year in pre-tax labor costs. If the equipment has an expected life of 5 years and if the firm pays income tax at the rate of 33 1/3%, is this a worthwhile investment? The following table shows the cash inflows and outflows associated with this project. The first content is sales revenue. The second one is labor costs. The third one is other cash expenses. For the depreciation, the new equipment costs $2 million with an expected life of 5 years. By the straight-line depreciation method, the depreciation for this equipment is $2 million over 5, $0.4 million per year. This means the depreciation will increase $0.4 million per year. The pre-tax profit is equal to revenue minus labor costs, other cash expenses, and depreciation. At the tax rate 33 1/1%, the income taxes are equal to the tax rate multiply the pre-tax profit, and the after-tax profit is equal to the pre-tax profit minus the income taxes. By the cash flow formula, cash flow is equal to net income plus non-cash expenses. Here, the net cash flow is equal to after-tax profit plus depreciation. The column 1 shows all the contents without the investment, whereas column 2 shows them with the investment. Column 3, the difference between columns 1 and 2, is the increment due to the investment. There are two methods to calculate the NPV of the investment of the new equipment to see whether it is worth to undertake the project. One approach is to calculate the net present value of net cash flows without investment and the one with investment over 5 years. That is, calculate the net present values based on the net cash flows in columns 1 and 2 separately, and then calculate the difference between these two NPVs. If the difference is greater than the initial cash outflow of $2 million to purchase the equipment, undertaking this project is worthwhile. On the contrary, it is not worthwhile. Another simpler way is to calculate the NPV of the project applying the incremental cash flows in the column 3. In each of the 5 subsequent years, there is a cash inflow of $0.6 million, which is the increased net profit of $0.2 million plus the $0.4 million in annual depreciation charges. The cash flow diagram for this project is as follows. To compute the NPV of the project, we need to know the project's cost of capital K. Let's assume that it is 10% per year. Apply the formula of NPV for projects. The net present value of this project is $274,472. This means the labor cost savings are worth more than the $2 million cost of acquiring them by undertaking the project. The wealth of current shareholders of the firm is expected to increase by this amount if the project is undertaken. We'll suppose that investing in the equipment would reduce labor costs by $650,000 per year instead of $0.7 million. Would the investment still be worthwhile? In formal assumption, the labor cost saving would be reduced $0.7 million per year. Now it is supposed that the labor cost saving would be $650,000 per year. So the labor cost would be $1 million minus the reduced part and equal to $350,000. Recalculate the following contents in the column 2, and then compute the difference due to the investment in the column 3. Consequently, the incremental net cash flow in years 1 to 5 is only $566,666 instead of $600,000. In other words, the incremental net cash flow falls by $33,333, which is 1 minus tax rate multiplied the change in before-tax labor cost savings. Combining with the initial cash outlay to the new equipment, $2 million, the cash flow diagram for this project is now as follows. Apply the formula of the NPV for projects again. The NPV of this project can be obtained as $149,110. The NPV falls but still remains positive. Therefore, the investment of this project is still worthwhile. In summary, we discussed how to analyze cost-reducing projects by an example in this section. The key point is to calculate the incremental cash flows and then calculate the net present value of the projects. That's all about this section. Bye.